Hello, my CFA friends. How are you doing, my lovely friends? It is time for more economics. Are you all buckled up and ready for launch? In three, two, one. Right. Okay. Say hello here to my little friend. And let's get started. Okay, we're going to be looking at monetary policy, right? So we've seen fiscal policy, which was the interplay of governmental spending and taxation. And now we're going to start looking at monetary policy, basically money printing, restriction of money supply, expansion of money supply, and so on and so forth. So let's get started. Okay, well, here is our exam focus. We're going to talk about the roles of your central bankers. We're going to look at the three typical monetary policy tools, which are the required reserve ratio, the policy rate, the open market operations. We're going to talk about how we determine the neutral interest rate and how we can decide whether we're going to be expansionary or contractionary vis-a-vis the neutral interest rate. But we're also going to talk about some limitations of monetary policy. And we're also going to finish by talking about how monetary policy ties together with fiscal policy. Okay, so what are the roles of my central bankers? Well, of course, they are going to be the player who determines money supply, right? They're going to formulate, they're going to apply their policy. They are monopoly of money supply, okay? They also will be the banker to our government and to the wider banking system. They can also be the lender of last resort. So if all else fails, a bank will approach the central bank for help. And here in the UK, we had our very own example of that, which was the Northern Rock, which in 2007 slipped into trouble because it had overexposed itself to basically, subprime mortgages, I guess, and it was over reliant on the interbank market. So when that kind of interbank lending market dried up, depositors started withdrawing en masse. The first day they withdrew £1 billion. I remember teaching that day, and I could sort of look through the window and see the long queue of pensioners withdrawing. The next day, the more savvy online bankers started withdrawing. Another 1 billion was withdrawn very, very quickly, and the bank essentially was at collapse when it had to be essentially bailed out. So the central bank is here the lender of last resort who can guarantee the depositors. But also the central bank can be a regulator, and also it can be a supervisor. So there you go. These are the sort of roles. You may want to, hit some QBank questions just to be sure that you know your definitions. And once you're done with that, just move on with your lives, because there's a lot more excitement to come in the rest of this economics readings. Okay, so a monetary policy is going to be looking at controlling the quantity of money in the economy. Okay, so what they're saying here is they want price stability. So they don't want runaway inflation, they don't want hyperinflation, they don't want double-digit inflation. They generally want to keep the inflation rate around 2.5%, 3%. Now, of course, bankers do like positive inflation, governments do like positive inflation, because of course that means that their huge piles of debt are worth less every year. I would argue individuals dislike inflation because that means that every year your hard-earned money is worth less and less. But let's not digress too much here. The objective is price stability, so they're going to want to keep a kind of low but positive inflation rate. And also, other objectives may or may not include trying to keep full employment. Now, remember, with fiscal policy, we could try to keep full employment by running expansionary fiscal. Now, here we're saying the central bank may also have that policy. Again, output, try to keep yourself to the potential GDP level or the full employment level of the economy and maintain confidence in the entire system. Okay, so now what are the tools? Remember, there are gonna be 3 tools that we should be able to talk about. The first tool is the policy rate. So this is the interest rate that the central bank is gonna charge other commercial banks in the system. So if a bank within the system wanted to borrow reserves from the central bank, it does so at the policy rate. And this policy rate can be changed by the central bank up or down, and it will have trickle-down effect in the rest of the system. For example, it could affect the federal funds rate, which in America is the rate at which one bank can borrow from another bank. Here in the UK, we used to use a lot the LIBOR, the London Interbank Offer Rate, but of course that's now being replaced. But my point here is you've got this policy rate, which is the rate the central bank will charge other banks. And if the central bank wants to be a bit more restrictive, and if it wants to sort of reduce the rate at which banks are lending, then it can increase this rate. And that effectively will make it more expensive for the rest of the banking system to borrow from the central bank. And they in turn will have to increase their own rates, right? So increasing interbank lending rate or increasing the policy rate, which would increase the interbank lending rate, would decrease bank lending and the money supply. The last bullet should hopefully make a lot of sense now. The second and most often used tool is your open market operations. This is when the central bank, essentially, if you're in America, you will be, of course, talking about the Fed. So the Fed is going to be buying or selling government securities to increase or decrease money supply. So if they wanted to increase money supply, they will buy back bonds and release money into the economy. But if they wanted to increase money supply, then they will have to do the reverse. Okay, so buy bonds, increase money supply, sell bonds, reduce money supply. That's how it works. Okay, and of course, that's going to have an impact on the cost of money, which is your interest rates. The cost of money is your interest rates. And notice also you've got quantitative easing, which is this sort of newish, not very new, but newer idea that when you are near or at 0% interest rates, you can just keep going. You can buy more bonds, you can buy other assets like mortgage-backed securities, release more money in the economy, basically keep trying to stimulate the economy. Because once you have 0% interest rates, you can't stimulate the economy further by lowering interest rates. So you're going to want to stimulate it by releasing money in the economy. Now, of course, that's not a very good idea, in my opinion, because as you can see, it hasn't worked at all. But again, that is a topic for another day. So let's stay here on focus. Required reserve ratio, which is seldom used, is basically this idea that if someone deposited $100 in the banking system, the bank cannot lend all $100 because it has to keep a portion of the $100 in reserve. That's where the reserve ratio comes from. So if I deposited $100, they'll have to keep $20 in reserves, let's say, with a 20% reserve ratio, and lend only $80. Now, these $80 will find their way back into the system. They'll get deposited, and the process will repeat. 20% of the $80 will be kept in reserve. That'll be $16, and the rest will be lent to a new borrower. So that's where this idea of mana multiplier comes from, if you have ever come across that. And if you've come across the idea that banks can create mana, they can do that by lending ad infinitum, right? Lending ad infinitum. And essentially, what happens is if you wanted to restrict mana supply, you're gonna want to increase the reserve ratio, and conversely, if you wanted to ease mana supply, you will reduce the reserve ratio. Now, some banks around the world have actually completely stopped using the concept of reserve ratio, so they don't set it any longer, in which case, if I deposited $100 in the bank would be theoretically allowed to lend all of that mana. Now, is that a good idea? That's a topic for another day, but they could theoretically lend all of that mana. Okay, so here is a little diagram of how we reach the equilibrium interest rate. Remember, interest rates for the layman is simply the cost of mana. Okay, so it's where money supply where money supply intersects money demand. Okay, notice that our money supply curve here is vertical. It's perfectly inelastic, meaning that money supply is fixed, right? The quantity is fixed regardless of its cost. The reason being that it is determined by the central bank, by the Fed, right? Whereas money demand is a downward sloping line, in this case, a curve, indicating that there's an inverse relationship between interest rates and the quantity of money in the economy. And why is that? Or not quantity of money, but the money demanded, essentially, the money demanded. So if you had a low interest rate, a lot of money will be demanded, and if you had a high interest rate, not a lot of money will be demanded, basically, is what they're trying to say here. So let's see the mechanism via which we can reach our equilibrium interest rate. So let's take this point here, high interest rate. So if interest rates are too high compared to the equilibrium interest rate, then not a lot of mana is being demanded, but a lot of mana is being supplied to the market. Okay, so there is excess mana in the economy, and that means that we will have to use this mana to buy securities. Okay, so what we're going to do is we're going to buy bonds. So bond prices will go up and interest rates will drop. So this interest rate that is considered too high is going to start dropping, and it's going to reach the equilibrium interest rates in the middle. Now, on the other hand, if interest rates were too low, then a lot of mana will be demanded, but not a lot of mana will be supplied relative to the demand. Okay, so there's too much demand now and not enough supply. That'll prompt actors, that'll prompt individuals and banks and all the other actors to sell bonds. This will push bond prices down, and it will start pushing interest rates up. up to the point that we're gonna again reach our equilibrium interest rate. Okay, that'll be our equilibrium interest rate. And that kind of explains how this whole thing works. Now, if I wanted to extend a little bit this idea, let's think about what expansionary monetary policy would look like. So remember, this is our vertical money supply at time zero. This is our downward sloping money demand. And let's say here, my banker says, well, I think interest rates are too high. I think I need to stimulate my economy. So what they do is they push money supply to the right here. And as you can see, the intersection point, i.e. the cost of money, drops from R1 to R2. Now ask yourself how they could have achieved that. Well, firstly, they could have bought securities in the open market. So the open market operations, buying securities will release money in the economy. They could have lowered the policy rate, which would have eased the cost of borrowing for other banks and consequently for the rest of the economy. Or thirdly, they could have lowered the reserve ratio, assuming the reserve ratio wasn't already at zero. Okay, so this first diagram shows you how we reach the equilibrium, which is the intersection. The second diagram shows you how we can now play with the level of interest rates by either running expansionary monetary policy, which is moving the money supply line or vertical line from left to right, or restrictive money supply, which would be moving the money supply line from right to left, basically reversing what we've done in this picture. Okay, so we've got a little question here, my favorite part. Actually, my friends, my favorite part. So let's have a look at this. So I've got monetary policy is least likely to include. Okay, so this is the question where you need to look for the wrong answer. So least likely to include setting an inflation target, or changing an official interest rate, or enacting a transfer payment program. Now, this question is a uber easy question if you've been following the videos, because if you've already watched the fiscal policy video, then you would know that in that video we talk a lot about government spending, taxation, transfer programs of things like benefits, right, redistribution programs. They are associated with fiscal policy, not with monetary policy. So that's going to be our right answer here, or in our case, the least likely to include, right? Monetary policy should not include a transfer payment program. Just to rule out the other ones, remember one of the goals was price stability, so low inflation. So having an inflation target is reasonable. Changing an official interest rate, well, that's referring to the policy rate. So yes, that is part of your monetary policy. Okay, now let's have a look at the transmission mechanism. So this is just gonna tell us how, remember the analogy of the plane, the cockpit of the plane, the buttons, the levers, you're pushing, you're pulling buttons, what is actually happening? Flaps down, the various things in the plane. So what we are gonna do here is we're gonna look first of all at the 4 channels. Remember the 4 channels and they're interrelated channels. So we've got lending rates, okay, which kind of makes sense. So you could be looking at interest rates basically. Asset prices, this is quite important. So when asset prices are high, you are feeling rich, right? If your house is worth a lot of money, if your pension plan is worth a lot of money, this is good for you, right? If you have great expectations of the future, if you think next year you're gonna have a big salary, a big bonus, then obviously you're gonna be more happy to spend today. And we're also gonna look at exchange rates, which of course affect the amount of exports and imports in the economy. All right, so I've got when central bank buys securities. So remember, before we read any further, just remember here, when I'm buying securities, I'm taking the securities in, I'm putting them on the Fed's balance sheet, which has ballooned essentially since 2008, just a quick FYI here. And then I am releasing money in the economy. Okay, so what's going to happen? Bank reserves are increasing. Well, obviously, right? Because I bought treasuries that were sitting on the bank's balance sheet and I replaced them now with reserves, right? Reserves is like basically, think of it as cash, right? It's not cash, but let's think of it that way. Then you've got, obviously, banks have more cash, if you like. And so if you have more cash, if you have more supply of something, the cost of that something will drop. So the cost of money drops, interbank lending rates decrease. Great. So this is the rates at which banks borrow and lend from each other. This rate is going down. So then short-term, long-term lending rates decrease. So if banks can borrow from each other more cheaply, then just generally all rates in the economy go down. So your businesses and consumers are now happy because they can increase the purchases of durables. They can buy more cars and finance those car purchases. They can buy more houses. Businesses again can buy property, plant, equipment, and they can borrow because it's cheaper. So the economy is starting to boom, starting to bounce. It's good for the economy, right? Also, because interest rates declined, foreigners are less willing to hold our currency, right? The currency is less yielding, so our domestic currency depreciates. And when our FX depreciates, that is good for our exporters because now the foreigner is finding our goods cheaper, so exports are going up, but we are finding their goods more expensive, so imports are going down. Okay, so all these things have the unanimous impact of boosting our aggregate demand, and aggregate demand being the output of the economy should have generally good impact on things like employment. But of course, also it will have impact on inflation depending on how close we are to full capacity or the potential GDP level. Depending how close we are to that, we may get a bit of inflation or maybe even a lot of inflation. Okay, so let's have a look at this question here. Transmission mechanism question, which is the most accurate statement regarding central banks and monetary policy. Okay, so we're looking for the accurate statement here. Central bank activities are typically intended to maintain price stability. Well, I think it's very, very similar to what was asked in another question. And also, this was basically the first thing that we said. The goal is price stability. So I am quite happy with this, and I'm tempted to circle this as being my right answer, but let's just rule out the other two. Bravo. Monetary policies work through the economy via 4 independent channels. Now, this is a sneaky one because it kind of sounds correct. What were the channels, right? Lending rates, asset prices, interest, exchange rates, expectations, right? But there are 4 channels, but they're not independent. They're interrelated. That means that these four things depend on each other. So that's going to be wrong. C, commercial and interbank interest rates move inversely to official interest rate. So official interest rate is the policy rate of the bank. So what this statement is saying is if the central bank increases the policy rate, then your lender should lower your mortgage rate. That makes absolutely no sense at all. Of course, if the Fed increased the official rate, your mortgage rate will also go up with that. So that's definitely not correct. So we're definitely circling alpha and moving on. Okay, second question. An increase in a central bank's policy rate might be expected to reduce inflationary pressure. Okay, that sounds right. Okay, so you want to increase a policy rate to reduce inflation. But how is this going to happen? Is it going to be by reducing demand, consumer demand? Or is it going to reduce the FX value of our currency? Or is it going to drive up asset prices, leading to an increase in personal sector wealth? Okay, so remember here, my goal is to reduce inflation by increasing the policy rate. Well, when I increase the policy rate, my friends, I make it harder for people to buy houses and cars because these are durable goods that require funding, right? So private consumption drops and that causes aggregate demand to drop and that basically cools down the economy. So A does sound like a right answer, my friends. So let's see why B is wrong. So increasing the rate will reduce the FX value of the currency. Well, no, it will not, because higher interest rates will attract foreigners to purchase our currency. And if they purchase our currency, its value will go up, not down. And driving up asset prices, well, already I can tell you that's wrong, because when you increase interest rates act as a discount rate. So the present value of future cash flow should come down. So things like stocks, bonds, they don't like high interest rate environment. They like low interest rate environment. So that's not going to be driving asset prices up. Not to mention that driving asset prices up is typically associated with inflation rather than reducing inflation. So that's going to be definitely wrong as well. Okay, but then they want us to talk about the neutral interest rate. So what is the rate that neither cools the economy nor heats the economy? Okay, so I'm going to take the trend growth rate of real GDP. So that's basically my long-term rate of growth of real output. Output measured in apples and pears and goods and services, not nominal paper money terms. Okay, so I'm going to take the real growth plus I'm going to slap on top of it my target inflation rate. And that's going to be my nominal neutral interest rate. So if I want to press on the brake, I'm driving my car and I want to slow down my car, I'm going to set my policy rate above the neutral rate. But if I want to press the pedal to the metal and accelerate, I'm going to set my policy rate below the neutral rate. Okay, so pretty self-explanatory, I would say. It's not difficult stuff. I don't believe this is really difficult stuff, guys. But just make sure you're putting in the right amount of hours and plowing on. That's the name of the game. So a neutral interest rate, if the economy's trend GDP growth rate is 3% and its central bank has a 2% inflation target, which policy rate is most consistent with an expansionary monetary? Okay, so firstly here, I need to figure out my neutral rate. Remember that neutral rate is your nominal neutral rate. So I want a growth rate, real growth rate of 3, but also want a compensation for inflation of 2. So my neutral interest rate is 5. So if I want to neither cool down the economy nor heat up the economy, I'm gonna set my policy rate as 5, right? But I don't want to do that now. I want to run expansionary. Okay, expansionary means I need to stimulate the economy. How do I stimulate the economy? Well, I set a rate that's below the neutral. There you go. A is right, B and C are wrong. Now, don't tell me, guys, this is hard stuff. Do not tell me this is hard stuff. Okay. Right, so what are the limitations of monetary policy? Okay, in fiscal policy, we also looked at some limitations. What are limitations here? Well, firstly, we can have inflation caused by supply side shocks, cost pushes. So, for example, if you have the oil price of oil skyrocket, this is known as a supply side shock, and that's going to cause inflation, right? And obviously, money supply, playing with the money supply here is not actually able to resolve the problem. It's a supply side problem, so you're gonna want to address the underlying problem, probably by trying to again expand supply of whatever underlying item or raw material is causing this supply side shock. Okay, but then we've got some issues with the transmission mechanism. So you've got market participation expectations. So here it's a lot to do with what participants are obviously expecting. So let's say our governments are running this reckless QE program, so very, very loose monetary policy that will cause short-run rates to obviously drop. But of course, we know that when we run our mana printer, expected inflation for the future goes up. And if expected inflation for the future goes up, that means that long-term rates will go up. Okay, so there's the expectation, guys. So government's running QE right now. Okay, all good. Short-term rates are low, but players already see this incoming tsunami of inflation. Expected inflation in the long term is high, so to get compensated for that, long-term rates have to go up. The opposite of that is QT, of course, quantitative tightening. If the government or the central bank are tightening too fast, too quickly, too hard, then short-run rates are going up. But again, expectations might be that future inflation will undershoot the target, and therefore long-term rates have to come down. And this is obviously contrary to what short-term rates are doing, so that's limiting the ability of monetary policy to be effective. Okay. Then you've got bond market vigilantes. Now, what is a vigilante? Vigilante is someone who takes the law in his own hands. Okay, so here we've got bond market vigilantes. Well, they're basically market participants, but they are going to be trying to, again, play with expectations and either buy or sell long-term bonds accordingly, right? So, for example, If they think that inflation in the future is gonna be rampant, well, they will have to sell government bonds, right? So if inflation in the future will be rampant, they'll just sell government bonds, long-term government bonds, causing interest rates to rise. Okay, because obviously those rates should compensate us for the high inflation. But if they think that, the government's being too tight and inflation is going to be too low in the future, they can do the opposite, right? So here they can buy government bonds, pushing long-term rates down. So they're kind of trying to, correct any perceived mistakes made by the monetary authorities. And then you've got liquidity trap. Liquidity trap is where the money demand curve, my friends, becomes perfectly elastic. So if you remember what that is, a perfectly elastic curve is a horizontal money demand curve. And what that means is that the price of mana is fixed no matter what the quantity of mana is. And why would that happen? This would happen when perhaps individuals, banks become super conservative and concerned about other counterparties, and they just decide to hoard mana. They don't lend the mana, they just hoard the mana. Okay, and I think that happened during the GFC, because even though we were printing and even though we were easing, lenders refused to lend. And that's kind of the idea of this liquidity trap. You can print mana and put mana in the economy, but if people are not willing to lend it, if people are just wanting to hoard it, then that's gonna put a limitation on the ability of monetary policy to stimulate the economy. Okay, so then we have to sort of think a little bit about the relationship between fiscal and monetary. So you've got basically 4 combinations here. So if we start in the top left with expansionary fiscal and monetary, and then we'll work our way in a clockwise fashion to work through all of them. So if I start with the top left, I'm running expansionary monetary, expansionary fiscal. Now, obviously, that's going to come as no surprise. This will be highly expansionary, right? You're going to have a huge boost on aggregate demand. Your private sector's going to grow because obviously rates are low, consumers are bouncing, buying cars and houses and so on. Public sector's growing because, of course, government spending, and interest rates here are likely to be low, assuming that monetary policy, the impacts from monetary policy dominate. And then let's move to the second box. So now we want to run expansionary monetary, but we want to run contractionary fiscal. Okay, so we're going to have expansionary monetary. That's still going to give us the low interest rates, right? Expanding money supply reduces the cost of mana. Okay, it's going to increase the private sector again for the same reason. You're going to have lots of consumers buying houses and cars. But the contractionary fiscal now means that the government's scaling back on its government spending, so that's reducing the public sector. Okay, now let's go down here. Contractionary fiscal, contractionary monetary. Now that obviously is going to massively reduce output. We are running both contractionary policies. Rates are now going up because we are reducing money supply, increasing the cost of money. Public sector is shrinking and private sector is also shrinking. Well, both policies are contractionary, so both sectors are shrinking. And finally, if we were to run expansionary fiscal but contractionary monetary, Well, interest rates will increase, right, because of the contractionary monetary. Government spending will increase because of the expansionary fiscal. So your public sector is growing, but your private sector shrinking because of the higher interest rates. So you can see here, this is a slightly more complex slide, but you can see how we logicked our way through it. So I suggest maybe just play back this section of the video a couple of times until it sinks in. And then I believe you will be more than ready for any eventualities here. Okay, so let's have a look. Fiscal monetary interaction. If fiscal policy is easy, okay, so that just means expansionary, and monetary policy is tight, okay, so we want expansionary fiscal and we want restrictive monetary. So then interest rates would tend to fall, okay, reinforcing the fiscal policy stance. The government sector would tend to shrink, or the government sector would tend to expand. Okay, so let's have a look. If I'm running tight monetary policy, I am basically reducing money supply. I'm increasing the cost of money. I'm not reducing interest rates. I'm increasing interest rates. So now I know alpha must be wrong. Now, if I am running an easy fiscal policy, that means I am a government spender. I'm increasing government spending. Now, what would that do to the government sector? You guessed it, the government sector will grow as a proportion of total GDP. So that's got to be wrong. C's got to be the right answer. And C effectively says the opposite of B. So yes, more government spending means government sector would tend to expand. Well, that's all for this section. Thanks for watching and have a great day.